Okay friends, welcome to part 4 of our video presentation on Tutorial C. In this part we will try to build the actual decision support system for the thrift shop case described in Tutorial C using Microsoft Excel 2013. So we'll just go section by section and we'll enter appropriate numbers and formulas in those sections. Again, I would like to remind you that it's worthwhile to read the first part of Tutorial C, which can be found on page 87 in your textbook, before you start this video tutorial, because otherwise some of the details may be a bit, new to you or unknown to you. So please read this tutorial, at least the first pages. I would say from page 87 up until page 102, up until Scenario Manager, because that's something we're going to use next. And once again, I'd like to remind you that the skeleton, the file itself for this demonstration can be downloaded from Canvas, so you don't have to create all those layouts yourself. So let's go section by section once again. So first of all, you have constants where you already entered 33 and 35%. That will be your tax rate for the next 2 years. And right now you are in year 2015. And as you can see here, you have certain financial indicators already collected for 2015. Here you have, in this section, you have your main inputs. You can enter whether you believe in 2016 the economy will continue to recess, meaning to decline, or it will start booming or start growing, right? In our case, we put R, meaning we expect that the recession will continue in 2016. And then also you enter your inflation outlook, whether the money will lose value, high or low. So you expect that the inflation will be high. Now inflation will have impact on cost of goods sold, because if inflation increases, then your cost of goods sold as a percentage of sales will grow a little bit, and those growth expectations are described in your textbook. So read and they even have tables that kind of summarize it for you. Okay, now let's work on this section, summary of key results. Now I told you before that this is what it is. I mean, it's a summary of key results. You don't do any calculations. You just pull those numbers from the sections that do actual calculations, just to give like a snapshot of the financial situation that is likely giving those inputs, and also giving whether you expand or no expand. So net income after taxes in the case of expansion will be basically just a replica of another cell. So you're putting equals this cell, C35. Okay. And then one good thing about Excel, once you enter that formula, you don't have to enter it here. You can just drag it by pointing your mouse to this corner, pressing left button, just like this. So basically this cell borrows value from here, net income after taxes. This cell borrows value from here. That's all you need. Then end of year cash of hand. Again, you're not calculating it here. You're borrowing this value from another cell. So more specifically, it will come from here. So when you do expansion, it will come from this cell, right? End of year cash on hand. Again, you just press your left button here in this corner and you drag it to replicate this formula and shift it here, so you get value from this section devoted to 2017. Now, so you did your not calculations, but data transfers from expansion scenario. Now you will do the same from no expansion, from this side of the worksheet. So basically, you're saying here, net income after tax, no expansion, can be found in this cell. And then once again, you just drag your formula here. And then the same thing for end of year cash. You get it from that no expansion section. Press enter, and then you just drag this formula. Okay. The values here are 0 because, obviously because here we don't have any values, and Excel is user friendly, so it kind of assumes that an empty value actually means 0. Okay. So we're done with this section. So later on, as we enter data here, this section will have values as well. Now let's start doing calculations. We're going to do calculations. First, we're going to do some minor calculations about total sales and cost of goods sold for expansion scenario and no expansion scenario. Okay. Okay. The first thing you will do, you will calculate sales. for 2016 and 2017, giving your possible scenarios. You will do this using a series of if statements. Again, it's worthwhile to go through some of those tutorials, at least through the first 2 parts of that 4-part tutorial on basic Excel functionality that I posted to Canvas, in case you don't know how to enter those formulas. If you know how to enter those formulas, then just continue with this tutorial. Even if you don't, just see what kind of values I'm entering in those formulas. And I think it's fairly intuitive, especially if you have exposure to any kind of programming language. Okay. So you're trying to estimate sales for the next year. Now, as it is stated in the case, your sales for next year will depend on certain inputs. More specifically, it will depend on whether you believe that the recession will continue in 2016 or not. If it continues, you're saying, if it continues. And the way you express this logical test is by saying whether this particular cell, but the thing is you put dollar signs here. Now the reason you put dollar signs to make sure the value of the cell doesn't shift when you copy this formula to this cell. If you don't fully understand what those dollar signs are doing, once you're done with this, try to remove dollar sign and then drag this formula here, and you will see that this value will shift here to NA, right? And this is not what you want. You just want to capture this value from one single cell. So in other words, you don't want the cells in the formula to be shifting with your drag. So that's why you want to keep it constant. So dollar sign means keep the cell constant. Don't switch to any other cells. Okay. If it equals R in quotes, right? Then the growth rate will be, then the sales will be this value times, and again, go to your textbook in tutorial C, and it has a table that outlines those growth rates. So basically you're saying, if you expand, and that's the section you're dealing with, expansion section, and recession continues, then you're expecting growth of sales of 30%. So it will be 1.3. You multiply previous year sales by 1.3. If you expand, but recession does not continue, you have boom, then you have a growth of 15%. So it's this cell condition if this is false. So this is condition. This is what happens if the condition is true. This is what happens if condition is false. False means it's not recession. It's boom. So in that case, we increase it by 15%. Okay. And then you can just copy this formula by clicking here in the corner, and here you have expansion. Now you need to calculate cost of goods sold for each of the year, given those scenarios. Again, you cannot just use let's start with cost of goods sold. Cost of goods sold as a percentage of sales, because by multiplying this percentage by revenue, we'll get cost of goods sold figure. Okay. Again, if you read the case carefully, you will see that your projections about cost of goods sold depends on the inflation outlook. Basically, what it says, what your case says is that if inflation is high, then your cost of goods sold will grow by 6%. If inflation is low, it will grow by 2%. So once again, you need to enter if statements. So you're saying if logical test, this cell equals H, meaning inflation is high, and again, don't forget to put it as a constant, right? Then value is true. You need to multiply this value by 1.06, meaning increase it by 6%. If false, meaning it's not H, it's L, then we multiply B20 by only 2%. We increase it by only 2%. Okay. And here we have 74% projection of cost of goods sold, giving that condition. And if we drag this formula here, it will be 79%. Okay. And then this part becomes easy. What we do, we just multiply, we put equal sign, we multiply this value times, we enter this asterisk, this. So this is our cost of goods sold in dollar value. And again, we just drag this formula here to get the copy of this formula, and with cells shifting. You see, cells are shifting from here to here. And because we don't have dollar signs, that's why cells are shifting. Okay. So we're done with this section. However, we're not done with the interest rate for a business loan. Again, if you read the case, you will find out that the case says that if recession continues, right, then the interest rate will be 5%. However, if the recession does not continue, then the government will lower their prime interest rate to 4%. By the way, I will do exactly what the case says. However, I think it's not very realistic, because in reality what happens is that the government is decreasing interest rate if recession continues, to kind of stimulate spending and business activity. And when the economy is booming, it's actually increasing. So I think the textbook kind of got it wrong. Again, it doesn't mean that the government always does that, but that's the typical practice. If recession continues, then the interest rate should be lower. However, they're saying, well, if the recession continues, that the interest rate will be higher. So it doesn't seem to be compatible with what the government, what the Federal Reserve system actually does, giving different economic conditions. But nevertheless, we'll do the same thing that the textbook says. If this particular cell equals R, meaning recession continues, again, don't forget to make it constant. Well, actually, here you're not going to drag it, so it doesn't matter. Then the rate will be 5%. Otherwise, it will be 4%. Now, note that you enter it as decimal numbers automatically, because this cell is formatted as percentage. Right? Automatically, it's being displayed as a percent. Okay, so you're done with this section. Now here, no expansion. You will also have a series of if statements, but the values of growth will be a bit different. Again, this is based on your case, right? So you'll need an if statement here. You're saying if this cell equals recession. See, I forgot to complete the formula. It gives me an error. And then again, don't forget to make it constant. Then, again, go to your tutorial C to see like those rates that they describe. If you don't expand, then if it's recession, then the growth will be 20%. So it equals this value times. Now don't multiply it by 0.2, because it will decrease the sales by 80%. So it needs to be multiplied by 1.2, which increases the value by 20%. And then if it's not recession, if it's boom, then the growth will be even lower. It will be only 5%. Okay. Again, why the growth rate is lower? Well, it kind of makes sense. So you multiply. Sorry. It's not 1. It's B24. You can either enter it manually, or you can just point with your mouse on that particular cell. Now, why the growth rate is slower, regardless of whether it's recession or boom? Well, because you don't expand, you don't have additional facilities to increase your revenues, to make more sales, to attract additional customers. So that's why the growth rate is lower here. And then once again, you drag this formula here. Now, the calculations for cost of goods sold are the same, meaning they depend on the economic outlook. So what we will do, we'll just copy this formula here to save time, hopefully, because sometimes when you copy, it doesn't save you time, you just get lost. Now, this will be the same. The cell needs to go down, so it's. So yeah, we're saying this cell is constant, right? And then instead of saying B20, we need to enter B26, right? Because this is our value. So you see, we're doing calculations based on this cell. Okay? And then we just make a copy of it by dragging it here. So you see, like, this is a constant cell, but this one switches, right, from B26 to C26. Because now we're increasing this percentage. And then here it's easy. We just multiply this value by the cost of goods sold expressed in percentages. Okay. So we're done with those two sections. What we're going to do next, we're going to work on those detailed calculations of income and cash flow statements. And those calculations, as I said already before, will be based on these calculations. So that's why we're doing it separately, because we want to make sure that the calculations are kind of simplified and divided into parts. Okay. Now let's calculate what we'll have, the amount of cash on hand we will have in 2016. Now this is very simple. The amount of cash we have on hand in the beginning of 2016 right, in the beginning of the year, is the same as the amount of cash that we have at the end of the previous year. So this cell equals to this one, and we press enter. And then we just drag this here, and now you see it takes the end of year cash amount from this cell. So that's what we need. Okay, sales revenue. Now sales revenue will be borrowed. This is expansion, right? So we need to borrow it from the expansion cell. And the same thing is here. Sorry, I forgot. Need to drag it. Okay. So we're borrowing from those calculations. Again, you see now it's simpler. Now cost of goods sold again will come from here, and we'll increase it here. I mean, we'll copy the formula here. Now here, since we expand, we're going to have a loan of $100,000, and there will be an interest rate attached to it. So the question becomes, what would be our annual payments? Again, read the case. The condition says that they will borrow it for 10 years, so we'll need to repay that loan for 10 years. Now, if we need to repay it for 10 years, we cannot just divide 100,000 by 10 years and pay, and capture here as $10,000 per year loan payment amount, because of course, as you know, there's also interest rate. Okay, so what would be the actual payment each year? There are formulas in finance, and they involve like exponents to calculate those payments. However, those formulas or models, remember we talked about financial models or basically tactical models used in decision support system. Those payment models are already implemented as a part of Excel functionality, so you don't have to do those calculations. You can just use a payment formula for that. Okay. Now this is what you do. You need to insert that formula, and the formula is called PMT. Okay, so you go to data, make sure your cursor is here in the cell. You go to formulas, then insert function, and you need to find this PMT function. In our case, it's right here. You're just saying we want to insert PMT payment function. This is the function that calculates payments on a loan. Okay. So what you need to enter rate, the interest rate, and what we do, we just point to the cell here saying it's this rate. Then number of periods, it will be 10 because we're going to repay it in 10 years. And the present value of the loan, this is the present value. This is how much we'll get. Okay, so we press OK. This is our payment amount. Now note that the payment amount is in red font and in parentheses. This is how they show negative numbers in accounting. So basically, it means it's a payment, it's an outlay, it's not an income, it's not money coming in. And we'll just make a copy here of this formula. Oops, something happened. Oh yeah, you see we didn't make this constant. That's the problem. So the rate is the same, so we make it constant, and then we just drag it here. And then we also need to make sure that this this cell is constant, the loan amount. So now it should work. So value means like this value error means like there is something wrong with the inputs to the formula. The values are not correct. So you see we'll have equal payment in this for both years. Okay. So what's your income before taxes? Well, this is how you calculate it. You need to take your sales, right? Then you subtract your cost of goods sold. And then you don't subtract, you add your loan payment. The reason you add because it's already a negative number. So as you know from algebra, plus and minus gives you minus sign, right? So you need to add this number. Okay, and you hit enter. So this is your income before tax. And again, you can copy this formula here. So what would be your income tax expense? Well, this is what you do. You multiply this value, which is your income before taxes, by the interest rate, right? Which is 30% for this year. That's what you're assuming. So that's your income tax expense. And then you copy this formula here. So net income after tax means you subtract this value, which is your income before tax, from the and then you subtract tax expense from it. So this is your net income after tax. So this is like your earning. Okay. And then what would be your end of year cash on hand? Now think about it. In the beginning, you had $15,000 in cash, And then as a result of selling those goods and selling them and paying your suppliers, meaning people who bring the items to your thrift shop, and also making a cash outlay for the payment, because all those things are on cash basis. It's assumed for simplicity. Your end of year cash on hand equals whatever you had in the beginning, right here, or here. It's reflected here. Whatever you had in the beginning of the year, plus the money that you earn, the income that you earn on the cash basis. Okay, so this is your end of year cash on hand, and then again you copy formula here. Again, if you go to the summary of operations, you see like all those values are being inserted automatically because you already specified that these values borrow values from these cells right here. Okay. So we're done with this part. So we have our expansion scenario. Now here we do the same thing. In fact, it's a bit simpler because here we don't have to deal with the loan payment, right? So beginning year cash on hand is this value. I'll do it very quick because it's similar to what we did here. Then we just copy the formula here. So for now it's 0 because we don't have any values. Sales comes from here. Sales for no expansion scenario, right? Again, we copy the formula here. Cost of goods sold, again, we copy from where we already calculated in the no expansion scenario. So this is our cost of goods sold right here. Income before taxes equals sales minus cost of goods sold. Okay, and then we copy this formula like this. Income tax expense equals this value times interest rate, right? So this is the formula right here. Then we drag it here. Then to calculate net income after tax, we subtract tax expense from income before tax. Okay, and we just copy it here. And what is our end of year cash? Again, this is the cash in the beginning of the year plus the cash that we earned as a result of our operations right here. So this is our end of year cash, and we just copy it here. Okay. So we build our model, and now it shows income in cash, and later on income in non-cash basis and cash reserves that we have at the end of the year as a result of expansion or no expansion, and also giving various input factors that we have: the tax rate, the loan amount, the interest rate, inflation outlook, and economic outlook. Okay. So now we're done. I mean, now we have the hopefully exactly the same model you have in your textbook. Later on, we'll try to kind of alter certain parameters and try to interpret those results in a bit more detail. But for now, just like a high-level interpretations that you have your financial possibilities giving those kind of parameters. So that concludes part 4 of our tutorial C presentation. Thank you for listening.